Okay, good morning to everybody. So today is the 30th, and we're going to start talking. We're going to pick up on talking about monetary policy, which is where we were earlier this week, and we're going to pick up on that from where we left off. And what's interesting about this is, I mean, this looks a little bit busy at times, and I really want everybody to realize that some of this is relatively straightforward in very many ways. And so I've got a set of graphs here I'll be showing you. It looks like it's kind of nasty, but it's really not quite as bad as when it meets the eye. So I want to pick up from where we left off last time. So chapter 15 is really, and I hope we get through all this today. If we don't, then I'll certainly try to do our best next week. But I don't think we're in any kind of press for time, frankly, because the major thing that we have left is to talk about fiscal policy and then some other issues that we'll sort of pick up toward the end here. So we're in week 12. We've only got two more weeks after this, 2.5 more weeks. And I think we'll probably do that very last. Well, in week 14, we'll talk about the fourth exam. Remember, we have a fourth exam and the last exam, which is in week 15. So we'll talk in week 14 about that fourth exam. In week 15, we'll come back. We'll probably review all of that. And in the last class session, we'll talk about the final exam. What to expect. It'll be your opportunity to ask questions, and it'll be basically open mic night for anybody who wants to sort of ask questions. Come to class if you like. We have a number of people who come pretty much every class session, and most do not, but it's your prerogative. But if you want to sort of have me work out things for you on the board, I'll be more than glad to do that. But we'll talk more about that as we get going, okay, as we get closer. So let's talk more about monetary policy. Remember, Chapter 14 dealt with money and banking, and it was an important chapter in the sense at the time that I said, look, it's a good lead off to where we're going to go, particularly into chapter 15, which is really, I think, one of the most important chapters in the book, to be honest with you. And when we talk about the Federal Reserve, we're talking about this idea of this agency that conducts our nation's monetary policy. Now, by the way, I know, and I have said this a number of times throughout the semester, but it seems like it's practically impossible to have a macro course and not simply at some point talk about the Federal Reserve. It pretty much comes up in almost every class session. And so let's talk a bit about the Fed. Who are they? What do they do? What are their roles, etc.? So this is from the Fed's website itself. So we'll talk about the structure of the Federal Reserve, and then we'll talk more about what some of the characteristics and some of the functions that they are for which they are engaged. Jerome Powell, who goes by Jay, is the chairman of the Federal Reserve. He was appointed by President Trump about 5 years ago. He was just reappointed for a second 4-year term by President Biden. One of the things about board chairmen in particular is the fact that they tend to not be particularly politically inspired and politically tied. And it really is the case. In fact, if you consider the fact, if you go back just in our recent past of chairman of the Federal Reserve, with the exception of Janet Yellen, who was nominated by President Obama and was not renominated by President Trump. Obviously, there were different parties. If you take a look at Alan Greenspan, who was first appointed by actually before him, Paul Volcker, who was appointed by a Democrat, Jimmy Carter, was reappointed by a Republican, Ronald Reagan. Ronald Reagan appointed Alan Greenspan, who was subsequently reappointed by another Republican, George Bush, a Democrat, and his son, George W. Bush. They tend not to be very politically oriented. Typically, the financial system has a lot of weight in as to who heads the Federal Reserve. Powell is a little bit of a different choice. He's not a career academic, as opposed to his first 4 predecessors, who were basically academic economists. And I think a lot of us feel like we've been fairly well served. But Powell seems to be doing a pretty good job. He's sort of a career. A lawyer by training, but works a lot in the financial world and also in the Treasury Department. So he does come with a lot of governmental and financial experience. So these are the board members. There are 7, and it looks like we've got a short down one at the moment. So and they serve for 14-year terms. And what's interesting about the 14-year term is that many of them don't make it 14 years. Even the chairman and vice chair, who have 4-year terms in those roles, chairman and vice chair, still have 14-year terms. And as long as they don't exceed their 14-year term, they could stay on there for that entire length of time if they want. What's interesting about the former chairman, Alan Greenspan, who was pretty much a household name back in the 80s and 90s, and even in the 2000s, he was there that long, was the fact that he served 19 years as Fed chairman. And so you might wonder, well, 19, how does that how is 4 divisible into 19? How is even 14 divisible? Or how is 4 divisible into 19? How is 14 divisible into 19? And it works because as long as the president keeps nominating for 4-year terms and is confirmed by the Senate, he or she can stay there indefinitely. But the problem is you can only serve 14 years on the board itself, but you can serve out the remainder of someone else's 14-year term, which is what Greenspan ended up doing. At the end of his 19 years, he was dead. There was no law were changed. There was no way for him to stay longer. And I think it was probably ready at the end of 19 years, heading the nation's central bank. We've had subsequent people since then. So there are typically 7 members. They very often do not stay in that role all the time. There's a particular graphic here is actually in your text itself. Basically, the structure of the Federal Reserve in terms of the banks. There are 12 district banks around the country, and the reason for obviously there's the headquarters in DC, which is the star there, but the reason for the breakup of district banks throughout the country is a little bit outdated in some ways. In some ways not, I suppose, but the original tends to have been sort of negated over time simply because of the fact that technology, electronic movement of money and information and whatnot. In the 1913, when the Federal Reserve was created, it was created in the wake of a big financial crisis of 1907, which was essentially resulted from banks across the country sort of moving their reserves to New York banks. And New York banks were paying higher rates of return on those reserves. Remember, reserves are those assets. You make a deposit in a bank, it becomes a liability and an asset simultaneously. That asset to the bank is a reserve. They can do whatever they want with it. They can lend it, they can invest it, and whatnot. Instead, they chose to put it on deposit at other banks, and it typically higher interest. It was called pyramiding of reserves. And what happened was, and I know that sometimes for those people who work in the financial area, whether it's banking or investments, oftentimes the fall is considered to be a very risky time for the financial markets. And it really comes from the fact that during the fall, obviously in many parts of the country, like, I don't know, all this part of the country, where there are grains being harvested and whatnot, the farmers have to be paid. And so there's basically this giant movement of cash, this direction that sort of results in a liquidity issue. And so in order to break those up, the Federal Reserve district banks were created so that banks could keep their reserves on deposit at the Federal Reserve at their district bank. So as a result, regionally, it was sort of stuck in, it was sort of lodged in place so that it didn't all flow to one particular place. Now that idea is a little bit outdated in the sense that money can move everywhere around the world instantaneously with a click of a mouse. But nonetheless, today the Fed district banks serve a function, particularly in terms of providing support to the banks that are domiciled within those districts. We'll talk about some of those functions. So notice, here's where we are here. We're in the 10th district. Looks like we might be the 11th, which is the Dallas Fed, but we're not. Albuquerque is in the 10th district, which is Kansas City, which Kansas City is right there. So Missouri's got 2 Federal Reserve districts, St. Louis, the 8th district, Kansas City, the 10th district. They don't have the cities under, but it is the Kansas City Fed. And there's some rumor about why that is the case. It was thought that the Federal Reserve Act was not going to pass, and a senator from Missouri insisted that Missouri gets 2 headquarters of a Federal Reserve District, 2 Federal Reserve District headquarters. Now, whether that's true or not, I don't know. It could be backroom. It could have happened in the back room somewhere. It could be just a rumor. It doesn't really matter. But it's the only state that has 2 districts within domicile within it. So, and notice the 10th district covers a lot of the states that are bordering us. I think Valencia County is actually part of the 11th district. So, and clearly all of southern New Mexico is in there. So, so our Federal Reserve president is named Esther George, and he periodically comes to town and meets with economists and whatnot. So that's always a fun thing to do. And so when we talk about the Federal Reserve itself, let's talk a bit about the structure of the Fed. And let me try to just show you the Federal Reserve is organized. I've got some slides also that will show you some of the structure. If I can find this, if I can find the part that I was looking for here. Let me see if I can find it. Because there's a very good little illustration on the Fed's side itself that sort of shows what the organization. I guess it helps if I can type, right? So Federal Reserve.org or .gov, right? Okay, and structure. There we go. That's what I was looking for. Okay, so this is the structure of the Federal Reserve System. I think it's important to note I've been saying throughout this semester that trying to do that, and it's oftentimes not clear. And in fact, as I've said before, it's really kind of odd that we don't, in most macro courses, simply because the need to present all this preliminary information first as to econ in general, that we really don't get to the Fed until a little bit later in the course, which seems a little bit out of order, particularly as important as the Fed is. But this is the structure. So the central bank is based in Washington, D.C., which was set up to do a number of different things. And we're going to talk specifically about what those functions are. The most important of which, for our purposes, is going to be managing the money supply. And that's what we're going to be talking about a bit later. The key entities, the Federal Reserve Board of Governors, there are generally 7. Right now, we've got a vacancy. So President Biden will have to nominate a new person and have to be approved by the Senate. 12 district banks that we talked about. And then this very important committee called the Federal Open Market Committee. We'll talk about who those people are. It's basically constructed of the Federal Reserve, the as well as 5 rotating members from these districts. And one permanent member of that is the 2nd District Fed President out of New York. And that's just been an historical precedent, given New York's sort of preeminence in terms of the financial center of the country. And lots of banks are headquartered there, lots of big banks. And Federal Reserve Bank of New York has got sort of a special role. So all 7 members of the Federal Reserve Board are members of what's called the FOMC, Federal Open Market Committee, the New York Fed President, and then rotating members. And right now, I don't believe Esther George is on the FOMC, but they rotate for 1-year terms on and off of that committee. And that committee is really, whenever we hear on the news, the Federal Reserve did, of course, the last year, we've been hearing the Federal Reserve raised interest rates, which is what they've been doing. What they're really talking about is the FOMC, the Federal Open Market Committee, that is composed of those 7 board members and those 5 rotating members, one of whom is permanent. That's really who is doing those decisions. And we'll talk about what those decisions are and what those tools are that they announce in order to deal with certain problems that are going on throughout the economy. Okay, so let's talk a bit about the Fed. And I know the slide package is up on the Brightspace side. So let's talk about what the structure of it is. So I said it was created in 1913. And by the way, central banks were not new. This is sort of new to us. 1913 is only about 110 years ago, but there have been banks around the world, central banks, that is government-controlled banks, government banks, in other words, which is what a central bank is. The Bank of England has been around much longer than what our Federal Reserve has. And there's been a long, I mentioned this in class on Tuesday, and it sounded like maybe I was sort of, I don't know, maybe off out of my mind a little bit, I don't know, but there have been times in this country where banking and bankers and even paper money itself has been considered to be very suspicious. And a long time, and so there was this suspicion for a very long time, particularly throughout the 1800s, our first full century as a republic, where a lot of people simply, particularly people in power, did not want this central bank. And there were all kinds of fears of, well, we're going to become like a European country, which we don't want. It's going to be this dominant, this gigantic octopus that's going to have tentacles everywhere throughout the economy. We don't want that either. And keep in mind that by 1907, which is when the banking crisis happened, that sort of pyramid crisis, you had a number of monopolies that, in fact, were in the industrial realm of things, sort of strangling the economy in very many ways. You had the Standard Oil monopoly, which controlled 90% of the petroleum refining. You had a number of monopolies in steel, railroads, leather, cotton, all kinds of monopolies that were popping up. And so the idea of one central government banking system seemed to be, feeding into people's paranoia about excessive power concentrated in the hands of a few. So it took a while to get going. It was only in the very first year of Woodrow Wilson's presidency, and in the wake, several years after the wake of the banking crisis in 1907, that the Federal, basically just a bunch of bankers and economists meeting from Washington in order to construct the Federal Reserve, along with a European named Warburg, who helped to sort of design what this would look like. So it took a while after that. And by the way, why was it necessary to create a central bank that was a central monetary authority when 1907 was the year in which we had basically a collapse of the financial system, the collapse of the economy? It was an actual depression that resulted. Remember, when we talked about recessions, we're talking about downturns in the economy. Depressions are simply defined as a deeper downturn, usually deeper and longer, and oftentimes due to something that's fundamentally broken in the economy, oftentimes financial. And by the way, in 2008, when the major banks were failing because of this crisis with subprime loans, had we had no government intervention, I think we probably would have gone not only into a recession, which we did go into, but probably a full-blown depression. And if that sounds like hyperbole, then consider the fact that in the absence of a Federal Reserve or any central bank throughout the 1800s, this country had numerous depressions, not recessions, depressions, the 1830s, 1850s, 1870s, 1890s, and 1907. And then we obviously had the big one, which was the Great Depression beginning in 1929. And there, even though the Federal Reserve did exist, they were making all the wrong decisions. But we'll talk a bit about what those decisions were and why they made them, which led Milton Friedman, the monetarist economist, to say that sometimes it's better that government do nothing as opposed to do the wrong things. And so he sort of got this reputation as being sort of skeptical of government. And I think there was reason to say that. In fact, I think when he had sort of a lot, like he was on his way out, he was very elderly, but a lot of economists was there, including at the time the Fed chairman, Ben Bernanke, who said, look, we all accept your premise that the Federal Reserve basically created the Great Depression because they did the wrong things as opposed to the right things. So my point about this is it took a long time to get going. By the way, this was the third effort to try to have something like a central bank. In the early 1800s, there were two separate attempts to create something like a central bank, not exactly like the Federal Reserve, with nowhere near the authority, but they were called, respectively, the First Bank of the United States and the Second Bank of the United States. They were consecutively year charters, where the First Bank of the United States ran out of its charter in 20 years. Congress refused to renew it, and it went away. Then it came back later States with a 20-year charter, and when that charter ran out, it was again, Congress refused to renew it. So we've had attempts to create this sort of stops and starts. And by the way, one of the big instigators against banking was Andrew Jackson, which is extremely ironic because he's on the $20 bill, but he was very suspicious about paper money, about banking, bankers. And in fact, I know there's been a lot of discussion with economists who are not psychologists or psychiatrists and historians, frankly, that Andrew Jackson might have been sort of clinically ill, mentally ill, because of the fact he did some very irrational things and could act extremely cruelly. And you know, his treatment of Native Americans is absolutely appalling, and no question about it. And so there's been efforts to try to get him off the $20 bill, which he probably wouldn't have minded anyway had he been around, but that seems to have been stalled. And so we'll see what happens with that whole thing. But nonetheless, my point is, it took a while to get this central bank going. So it was structured in both a centralized as well as a decentralized manner. That is a central headquarters in DC with a board of governors as domicile, as well as 12 district banks throughout the country. And those district bank presidents usually come from that district. Either they're from there, they work in that district. I know Austin Goolsbee is not from Chicago initially. He's now the new Fed president of the District Bank of Chicago, but he taught at the University of Chicago for several years, went to Washington to become President Obama's economic advisor, then went back to Chicago, and now is the Fed president there. And we'll see if he, if he goes further in the Federal Reserve System. So it's got this sort of decentralized manner, and the bankers, the central bankers in these districts are fairly the bankers within the particular area in which they work. And most of my career, I worked in the 7th District in the Chicago Fed, and there are always conversations about so-and-so talking to the Fed president of Chicago and having conversations with us. So they tend to be very much closer to the ground. One of the things that's interesting about the Fed, by the way, I should mention the Federal Reserve is probably one of those agencies that is subject to more, I guess, conspiracy theory is the word, than maybe any other agency, perhaps outside of the CIA or one of the intelligence agencies. There's been a lot of paranoia about the Fed, and it's been a long-standing sort of thing, and it's a little bit hard to sort of figure out. And it's very ironic too, because the Federal Reserve has tried repeatedly to make its operations and its thinking and its methodology more transparent to the public than it ever did. Now, this is probably where some of this comes from, is the fact that there was a lot of secretiveness about what the Fed was doing behind closed doors. It really wasn't until, say, the 80s and 90s when we had the internet begin, and well, the internet sort of began in the 90s, but cable TV and financial TV and the 24-hour news cycle when people really started to pay attention to what was going on. But Alan Greenspan probably was among the last to say, look, let's sort of keep what we do a little bit secret. There is a theory in economics, we talked about it, called the rational expectations theory, sort of a subfield of classical theory that says that monetary policy, which we're going to talk about what that policy is, works best when it surprises the public. That is, the public doesn't know what's coming. It's a little bit hard to do today because I think most people are really connected to what's going on. You can almost always know exactly what the FOMC is going to do whenever they meet. It's very rare that they do a surprise. In fact, the Fed president of, I believe, was Atlanta or Cleveland. I think Cleveland. Loretta Meister said that not this last meeting in March, but in January, they were prepared to raise the Fed funds rate by 0.5%, and they only did 0.25% because it was agreed that the public was not expecting a 0.5% increase. They were expecting a 0.25% increase. They are aware of what public opinion is. And so unlike in years past, when they would do things to surprise the public, they tend not to want to surprise the public. And this is probably due to the policy and public relations stance that was adopted by Greenspan's successor, a guy named Ben Bernanke, who really wanted some transparency of what's going on. Okay, so we talked about these members, 7 members, appointed by the president, confirmed by the Senate, and they're unelected. That's really the key thing to know. This is going to contrast greatly with when we talk about fiscal policy next week, that is budget policy, where the other government officials who handle that part of economic policy are elected. These folks are all unelected, so none of them stand for election. And why is that significant? One of the reasons why it's significant is the fact that these were deliberately set up to be non-political positions. And that is, they can make them unpopular politically, but were necessary from an economic standpoint, like what they're doing right now, raising interest rates, which is not particularly popular with anyone, but everyone knows it needs to be done because we've just simply got too much money floating around out there. And the evidence of that is all around us. Prices of goods keep going up. Remember, inflation is one definition that's a very useful definition, even though very scientific, is too much money chasing too few goods. Which is why if the government just simply emailed FedExed everybody $1 million, it sounds like a great idea, right? It sounds like a beautiful idea, except we'd all go buy clothes and trips to Disney World, and goods would go flying off shelves, and sellers would do what? They would raise prices because they would have a scarcity of goods, way more demand than what there was supply. Prices would go up and up and up, and they would never stop. And that's the problem. So it's one thing to get a little bit of boost, a one-time boost to the price level, and we've all got $1 million, maybe we save half of it, but prices never stop going up. It's the problem because nobody knows where it ends. And so when we talk about these unelected officials able to stop these expectations, and right now, this is the big challenge for the Federal Reserve, to try to get out of people's minds the idea that prices are going to go up forever. Now, by the way, there was some thinking. In fact, the interest rate futures market, which is a market that I'm heavily involved in with my firm, was thinking after these bank failures of Silicon Valley Bank and Signature Bank that maybe the Federal Reserve would not raise rates in March. Maybe they'd hold off on raising rates because remember, that's the cause of those banks' failure was rates go up, bond prices go down. We talked about that on Tuesday. Bond rates go up, bond prices go down. It means these firms banks were taking losses, which is basically what started the bank runs particularly on the Silicon Valley Bank. So there was some thinking maybe the Fed's just going to hold off, maybe so as not to cause any further damage to banks' bond portfolios. But the Federal Reserve decided, I think rightly, that the better move is to keep raising rates to squeeze inflation out and just to monitor banks a little more closely. And by the way, I know that there's been criticism. And by the way, let me just, by the way, but it's a thankless job, I think. And I think that a lot of people, you have to have a sort of a thin skin to do it because almost nothing the Federal Reserve does is popular with everybody. Somebody's not going to like whatever they do. And the fact that they're unelected just kind of fuels the fire. It's like, what's Powell doing? He's out of his mind. It's crazy. We heard this all the time when I was in the banking world. Everyone criticizing the Federal Reserve. They can't do anything right. They don't know what they're doing and whatnot. When in fact, I think that's probably very unfair criticism. It's simply because they're doing things that maybe some person doesn't like. And certainly in the financial world, people have higher interest rates, particularly if you're if you're a stockbroker, you don't want higher rates because it tends to make people save money more in the form of banks and CDs, and they can't borrow money as easily to buy securities. That is what's called margin buying, which is basically borrowing money to buy stocks. And it's a beautiful thing when rates are low, not so beautiful when rates are high, because it sort of dilutes that spread between what they earn and what they pay, borrow money to buy those. And so obviously the stock market doesn't always like what the Federal Reserve is doing. And so it's a thankless job. There's not much praise that gets set their way. Although Greenspan, toward the end of his career, I think was probably considered to be quite successful. And certainly Paul Volcker, who was his predecessor, put some really tough medicine into the economy in the late 70s, early 80s, really raised interest rates to dramatically high levels. I've got a chart I should have probably shown you that shows where those rates went in the early 80s, and it was like 21% in terms of the Fed funds rate, 20%, something like that. It was just unbelievably high rates to slow the economy down, to squeeze out inflation so that people didn't expect inflation to go on forever. So again, when I talk about the fact that the Fed raised rates in March, just this month, they did it even despite the fact that maybe will hurt other banks that have got on their books, but the broader issue is not to help banks survive, but to rather help the economy to thrive. And that's the bigger mission. And those people who are saying maybe the Fed will stop raising rates and maybe will lower rates have been sort of, I think, dreaming for a long time and probably promoting their own interests. And the Federal Reserve tends to do what's good for the economy, not what's good for ordinary individuals. But this was the design. We don't want people who are flying along with going along with public opinion or going along with political motivations. And in fact, the Fed chairman typically will act independently of the Congress and the president. He or she is appointed by the president and confirmed by the Senate, but once in the job every 4 years has to stand for renomination. But the president really has no control whatsoever about monetary policy, which, as we're going to see, is much more powerful at sort of managing the ups and downs of the economy. We call, stabilization policy is much more important than is Congress and the president. And I know that, and I've said this before, but I know that we have this idea that the president is this sort of all-powerful being, and is like the Wizard of Oz behind the curtain, flipping switches and turning knobs. But that's not really the case. It's just not the case. And there's really no lever for the president to lower interest rates, to raise interest rates. He's got nothing at his disposal. And in fact, even in the only realm of policy in which he does have control, he has to do it with the cooperation of Congress. And right now, the president has at least one house of Congress, one house, which is very much antagonistic to him politically. And so I don't know that he's going to get a lot done on fiscal policy going forward, at least while he has that sort of antagonistic thing. But that's Washington for you, and that's politics for you. It's, there's opposition. And this was to deliberately be apolitical, that is non-political. In fact, there have been cases in time, just to sort of to make clear the idea of the independence. There have been cases in which the Federal Reserve has sort of pushed back publicly against the admonitions and the things and the urgencies that have been imposed on by presidents, and have done just the opposite. I can remember in the late 80s when President Bush first raising rates aggressively, probably too much, frankly, and the president and his publicly urging the Fed to lower rates. Instead, the Fed just decided raising rates, and they might have been better advised to have paused or maybe to thought about lowering rates, because it probably did cause a bit of a recession that was unnecessary that happened in 1991. But and certainly the Bush family believes that President Bush's failure to be reelected, the first President Bush's failure to be reelected, was caused by excessive monetary tightness, which resulted in a slowdown in the economy. This is after winning a war in a very, very big way. So economic things really impact people's opinions, and so, but the president really has no control over those elements which are most important, which is the money supply. Okay, we talked about the district banks. We went over that. We talked about the Federal Open Market Committee and the rotating membership of 5 presidents. Let's talk about a bit what the Fed does. This is just to sort of give you an appreciation of the activities that the Federal Reserve does. This is my own particular way that I view it. It's the brains of the brawn of the financial system. So brains and brawn, what am I talking about here? Well, the brainy aspect are the things like conducting monetary policy, serving as a bank regulator. The brawn is more of these physical things like providing cash and coin to banks and maintaining electronic payment systems. And so the Federal Reserve is a big organization, does a lot of things. But by the way, and one of the points on the previous slide that I didn't talk about was the fact that it was self-funding. Now, why is this important? It's important because it helps to maintain the Federal Reserve's independence. The Federal Reserve gets no tax dollars whatsoever. And in fact, on the contrary, it does earn it. Where it makes its funding is on interest that it earns on government bonds that it buys, mostly treasury bonds. The interest, oftentimes, if it's excessive, it's over and above what it needs to operate, just its own administration. It gives it back to the Treasury. And the Federal Reserve is periodically giving money back to the US Treasury because it doesn't need all of it. But the point is, it doesn't rely, they don't have to go cap in hand to Congress and say, we need money. And that's one way that they prevent Congress from having control over what they do. In fact, the law that mandated the Federal Reserve chairman appear twice a year before Congress has long since expired. But chairmen since that time have complied with it, mostly out of custom. And I think it was about 2 weeks ago that Jerome Powell went to Congress to testify. And it's tough questioning from some senators. And, but that's to be expected. I get it. It's a thankless job. I'm not sure it's a job I would want, but not that I'm in line to get that job. But I think it's a tough one because you've got it coming from all sides. So the most important role is the central bank. So it's the government's bank. So if you ever get a tax refund from the government in the form of a check, it'll be drawn on the Federal Reserve. If you look at the money in your pocket, it'll say Federal Reserve note. In other words, it's the issuer of currency. So it's basically the central bank. Now, I know that you might say, well, where is the Bureau of Engraving and Printing? Well, that's part of the U.S. Treasury that physically prints the money. And the U.S. Mint is the part of the U.S. Treasury that physically coins the metal pieces that we have in our pocket, but it's the Federal Reserve that creates the money. And they have, and the Treasury, by the way, the U.S. Mint and the Bureau of Engraving and Printing have one customer, it's the Federal Reserve. That money goes to the Federal Reserve and it gets distributed to banks. So if banks need money, they contact the Federal Reserve and say, this is what we need. The Federal Reserve sends here's that. They basically just debit they take a charge to their reserve account to give them the cash. Likewise, where does money go to die? It goes to die at the Federal Reserve. Have you ever had a bagged up dollar bill? It looks like it's been run over 24 times and shoot up by a dog or whatnot. That money goes to the Federal Reserve and they just burn it. And they credit the bank's reserve account and say, okay, that dollar is no good. What we call mutilated currency. And so they do a lot of that physical stuff of handling cash and coin. And I don't know what this coin shortage is about. I keep hearing about this, and maybe it's getting a little bit better, but I don't know if you saw this about a year ago or so that everywhere you go, it's like everyone is short of coins. And I don't know if that was something pandemic related or what. I mean, I think restaurant one time I had like 60-some cents of change coming, and they didn't give it to me because they said, it's like, well, wait a minute, you're going to give me change, the dollars, but not the change. So what am I supposed to do? If they don't have it, they don't have it. So I guess maybe it's a good argument to pay with the debit card so they can round it off. But so I don't know what that's about. Maybe if somebody knows, they can, if you're watching live, you can put it in the chat box or let us know. But it does appear to be getting better. But I was wondering, that was the first time ever, and I've been doing this for a long time, that I've even heard of something as seemingly ridiculous as that. Where's all the coin going, first of all? So it's the central bank, it's the government's bank, so it maintains essentially the government's checking account, if you like. The government draws checks on the Federal Reserve Bank because it does serve as the government bank, like what your bank serves you in that regard. They can take money in, they can put money out, they can loan money out, they can have it repaid. From our perspective in this course, the nation's monetary policy is what they conduct. And when we talk about monetary policy, what is the definition? I'll give you a formal definition. Supply and the availability of credit. And I'll give you that formal definition in a second. It's also, and when we talk about brains and brawn, we're talking about all these different purposes of the Federal Reserve, which you might think, wow, there's a lot going on here, and there is. It's also a banker's bank. And that is the fact that banks, just like any other entity, like households and business firms, have to have a bank themselves to hold their reserves. So they have to hold required reserves. And we talked a bit about that when we talked about the money multiplier. And that is the idea. every bank deposit has got to have some of that deposit set aside. Now, it's not on both M1 and M2 deposits. I think right now it's just on M1. But it's got to be set aside at the Federal Reserve District in which the bank is domiciled. And you would know that by looking at the routing number on the check at the bottom of your check. First two digits correspond to the Federal Reserve District. So if you open it in Richmond Federal Reserve, it would be 04. If you open it in San Francisco Fed, it would be 12. So that's the 12th district. So it corresponds to that. And that's where those reserves go. Banks can also borrow from the local district Federal Reserve. There's a lot of things that they can do in order to serve as a banker's bank. They also serve as a bank regulator. This is a little bit, this is a touchy subject, particularly at this very moment, because it has been for several years, because this role of bank regulator is a little bit difficult to reconcile with what they actually do, because here's the problem with bank regulation. There's a lot of overlap in regulation. We probably at some point should revisit the way that we regulate banks, because we've got all these overlapping agencies. Primarily, banks are regulated and examined by the Treasury Department, okay? Which is different. That's part of the administration. That's part of the executive branch, reporting to the president. If it's a commercial bank, it's what's called the Office of the Comptroller of the Currency. That is the primary regulatory agency of banks. They do periodic examination, banks' solvency. They look at banks' books. And by the way, this Silicon Valley Bank, everyone was saying, where are the regulators? And the Treasury is saying, we were concerned about Silicon Valley Bank. We were trying to tell them to make some changes. And we were about to force them to make changes. The problem is a bank run is a bank run. And any bank, anywhere in the world, if depositors want their money out, that bank will fail. There's just no way around it. A bank is a house of cards. And now, obviously, it's probably unlikely that Citibank or JP Morgan is going to have a run on their bank, but who knows? It could happen. And I think the Reserve and the Treasury and the FDIC depositors going to be insured, whether or not they were within the insurance limits or not. Pretty unprecedented, right? And it may be regret down the road, but they were looking at this idea of stability. They don't want bank runs to get going. The thing about the regulation, though, is the problem is there's so much overlapping regulation. Treasury was looking at Silicon Valley Bank and all the other banks, but it's not just the Office of the Comptroller of the Currency, which is part of the Treasury, which is a regulator. It's also the FDIC, which is the bank insurance company. It's also state regulators. It's also the Federal Reserve. You've got all these different regulatory agencies. It's also there's a fairly new office that began after the financial crisis, which Consumer Financial, which, by the way, was formed because the Federal Reserve, in the Federal Reserve Act, one of the mandates was to serve as a protector of consumer financial protection, which was in the law itself. And I think that the Federal Reserve probably did not do a good job at protecting the public from some of these predatory loans that were being made, particularly these subprime loans that charge very high interest rates and early prepayment penalties, and really were underwritten in a very crummy way. People not verifying their income, not doing a lot of things that they should have done, and so it really was difficult. So because of that failure, I think that's why the Consumer Financial Protection Bureau was sort of created, because the Fed was not doing its job. By the way, don't take my word for it. Alan Greenspan, the former chairman of the Federal Reserve, in his autobiography, talked about the fact that they really dropped the ball when it came to subprime mortgage lending. They really did, and there's no question. They had very little to say about it. In fact, just the opposite. For years prior to that period of time, the Federal Reserve was saying that we know a lot more about risk management than we used to. There's no way we can have a full-blown bank crisis like the 1920s and 30s. We've got this. But it turns out they don't got this. And so that was a bit of a problem. They also do economic research and reporting. There's lots, particularly within the district level. So the 10th district, it's heavily on a couple of different activities. Agriculture is big, particularly ranching. Also, oil drilling and mining are very big in this particular district. So there's lots of research about what is going on in those particular areas that helps to provide to the public and to those who are involved in those areas information about what's going on, what the outlook is, what some of the threats are, and all those kinds of things. And so that they perform a pretty good role. For those of us who get these publications, it's free information, it's very good. It's usually a lot of PhD economists write out grad school, go to work for the Fed and do this as a career. They provide advice to the Congress and the president. We talk about point of currency, check clearing and routing. This is becoming less and less important because physical checks are sort of dying off, really. I mean, I don't know how many checks you write, but I don't write very many at all. In fact, I may write one a month, if that. In fact, I think it's very possible now to write no checks ever. And so this idea of check clearing is not anywhere near as important as it was in the not too distant past. And mostly it's because of technology, obviously, because even if you do write a check, it becomes immediately imaged in connection to wherever the bank was drawn on, where the bank is drawn on. So this is why you can even go to an ATM and deposit a check. It just scans the image, and the check itself is not important. It's the information on the check. And then electronic payment systems of various kinds. Okay. All right. Moving along here. What's the definition of monetary policy? We said this was the most important of the functions of the Fed. It's this definition: it's government management, the supply of money, and the availability of credit. The actor here is the Federal Reserve itself, which we simply call the Fed for short. So whenever you hear the word the Fed, it refers to the Federal Reserve. Not feds plural, because that tends to kind of bring up, I don't know, feds with handcuffs and coming through your door and whatnot. This is not the FBI. This is the Federal Reserve System, the Fed. And so two things: supply of money and availability of credit. These are tied in with these are sort of the flip side of each other. Supply of money is obviously the money supply that's out there right now. Credit, as we talked about Thursday, the creation of new money. So new money is created by bank loans that are created and make their way to the depository system. I see people take money out of the system and they bury it in their backyard. That's money that leaks out of the economy, and so we have no way of controlling for that. You can do it, but it results in what we call a leakage from the economy. Even savings itself is what we call a leakage, because it sort of breaks the income and spending cycle. And so this idea of saving is a double-edged sword, because it creates what's called the paradox of thrift. And that is the idea: as we save money, save, it results in a savings, but it also means that we short circuit the income and spending cycle as a result of that. Because you might think, well, why don't banks just lend that out? And that puts it back into play. You might have very few opportunities. And even during the depth of the financial crisis of 2008, 2009, the Treasury Secretary at the time said, look, if banks don't want to lend, I can't make them. And so as a result, they can't be forced to lend money. They can be forced to not lend money. I've seen cases in which banks were in very dire straits and they've been given orders not to lend money. And that's really that's right on the doorstep. It's only 1 or 2 steps away from being shut down by the FDIC, which is when a bank fails, it usually is the FDIC that comes in, that Federal Deposit Insurance Corp, that shuts the bank down, pays off the depositors, just immediately guarantees the depositors, and usually goes into new ownership right. I was involved in one of those when I was in banking, on the very tail end of it, where the bank I was working for came in and bought a bank that was shut down. They bought it that very day. And then they moved in that night, started looking through the books and whatnot that very day. So it's a very quick process. So the public does not experience any kind of loss. Okay. What are the tools of monetary policy? So there are really 3 tools, and I will tell you this, that even our textbook is a little bit outdated in this regard, and so this is outdated. But I don't want to get too far out of the textbook, because in the last couple of years, the Federal Reserve has been emphasizing, probably more than these 3 that are listed here, they've been emphasizing the federal funds rate, the Fed funds rate, as being the primary tool that they're using. So this is a little bit outdated. We're going to have to sort of adjust this. So why don't I update my slides? Well, I'll update my lecture and talk to you about that. But I don't want to get too far out of the head of the text. Now, the textbooks will probably be revised very soon, because this is a fairly new policy orientation where there's a recognition these 3 tools exist, but they're not all created equally. And that's, I think, the thing that we ought to know. They're not all of equal stature. And so this is an important thing for us to realize. And in fact, the one that's not listed here is probably one that's gaining in stature. And the current chairman has talked endlessly about using that tool, i.e. the Fed funds rate, as the main tool. So let's talk about what these are, and then we'll talk about the relative effectiveness of each. So the first is the management of the required reserve ratio. The RRR Remember, reserves are those percentage of deposits that banks must set aside. They can't loan, they can't invest it. It's sort of money set aside on the bench, typically at the Federal Reserve District at which that bank is domiciled. If you're a bank that crosses multiple Fed jurisdictions, like different districts, and there are a lot of banks that do that today because of the widespread interstate banking that's been going on for time. Wells Fargo, Bank of America, they operate across different districts, but those original charters of the banks which they have acquired in many cases still exist, which is why you still have the same routing number that you had, even if your bank has long ago disappeared. It's been absorbed by somebody like a Chase or a Citibank or a Bank of America or a Wells Fargo. Those are the four big banks in the country right now that that have sort of you don't have any problem with those banks, or else the economy is in really dire straits. It's what we call too big to fail. The Signature Bank and Silicon Valley Bank, they were probably third tier in nature. You've got a lot of very strong second tier banks like US Bank and Compass Bank and some of the, well, Compass Bank I think has been bought by BBVA, I believe, but those are regional banks. Regions Bank is another, not First Regions, which went down, but Regions Bank. Those are some of the second tier, but third tier banks like Silicon Valley Bank that probably gets a little bit less attention and probably more press than what was necessary. But the issue with reserves is up until a few years ago, banks didn't even earn any interest on it. They weren't interested, they're paid a rate of interest by the Federal Reserve, and they can adjust that payment, that interest amount if they want to encourage more, or lower it if they want to discourage excess reserves. There are required reserves and excess reserves. Remember, every time you make a bank deposit, it's a liability of the bank, they owe it back to you. It's an asset to them, they can do whatever they want with it, provided that they meet their reserve requirement, which they've got to meet every business day, every single business day. And by the way, if they don't meet that requirement, let's say they've made out more withdrawals than they expected, or they've had a lesser amount of repayment of loans or whatever, maybe they simply had to make payroll and so they're low on cash. What do? Well, the banks, and they borrowed overnight through what's called the Fed funds mechanism. Federal funds is simply the rate paid by banks to borrow money overnight from other banks. And it's really, so when we talk about the interest rate, the little I, the interest rate, which I know is problematic, and I've said a couple of times before that sometimes people say, well, what do you mean by the interest rate? Usually we mean the Fed funds rate. And it's a very important mechanism that allows banks to borrow from each other. And we're going to talk here in just a bit. So that's the first tool, required reserves. If they don't meet the reserves, they've got to borrow it. Where do they borrow it from? Banks that have got excess reserves. By the way, sometimes the rate paid on those Fed funds are very, very high. And I didn't find out until years after I got into upper management that in the early 90s, our bank I was working with at the time, I was wondering why we weren't lending money very much. Hard to get loans approved, and we were really crunching down. I know the economy wasn't particularly good, but they were really crunching down on loan requirements and whatnot. As it turns out, and I didn't find this out later, and they certainly didn't want this out on the street, but we were simply lending money to other banks at like 9% interest, which is a pretty good rate of return, considering that at the time, nobody thought lending money to a bank was anything but golden and safe. We have a little bit of a different view now, but that at the time we thought, well, this is easy money, 9% lending money to banks rather than to people. And so obviously that's not something that is good PR, and so it was not made public, not even to people in lower management, which is where I was at the time. I didn't find out until I got a little bit higher in the food chain. I started to learn that secret, right? So the second one is the management of the rate. This is very much tied to the Fed funds rate. This is where banks can borrow from the Federal Reserve directly from the Fed through what's called the discount window. Okay, let's talk about this. This has been around for a very long time. The discount window, it's this window itself is very much outdated. It suggests like a teller window where you used to conduct all your business across from a caged window. That's very old school, certainly. But it's the idea that if a bank wanted to borrow money, they could go to the Federal Reserve to borrow from it. And usually it was on fairly short terms, like 30 days and whatnot. And the rate of interest was set at what was called the discount rate, which, by the way, is almost always the very same as the Fed funds rate right now. And here's and what happened with this. So banks would go if they needed to borrow money, and it was a bit problematic in the sense that banks didn't really want to do it as much. And so that became a bit of a difficulty, but that is one mechanism by which the Fed can borrow from, or banks And by the way, it's not just banks, because the Federal Reserve has opened this up to other financial entities like mortgage companies, like particularly the government-sponsored entities. Sorry, my voice is kind of fading. I'm just trying to move around. And so there are other entities that can borrow from it, savings banks, etc., non-member financial institutions. I think that, and I think they opened this up to investment firms like a Merrill Lynch, Goldman Sachs, that sort of thing. Okay, and then the final one is open market operations. Open market operations are this active buying and selling of government bonds by the Federal Reserve. So, all right, so what's going on with open market operations, and what are they all about? Okay, so this is one of the primary means by which the Federal Reserve controls money supply and interest rate. We talk about the definition of credit. Well, if you might ask yourself, what do you mean availability of credit? What does that mean? Because I just said that they can't control the willingness to lend, but they control the ability. If the rate is high, it discourages borrowing. So the Federal Reserve can raise rates and thereby, signaling to borrowers, hey, I don't want to borrow money at these rates. I can't afford to, which is what we're seeing happening in housing right now. Housing is to a screeching halt. That is new home buying. Construction is still going on, but a lot of these projects were already started. But they're pretty much wrapping up now, because usually it doesn't take more than a year or so to build a house at the very outside. In fact, it's often much less period of time, maybe 90 days even. And so people who locked in rates a while ago are trying desperately to wrap those up, because rates are much, much higher. But new construction is coming to a screeching halt, because rates have gone up about 4.75% just in the last year or so. So that's one mechanism. But what about market operations? And we're talking about active buying and selling of bonds. What is that about? It puts money into the economy or takes money out. When the Federal Reserve, one of the tools that they use is this tool by which there's a lot of federal debt out there floating around in the economy. And it's the way that spending in excess of what it takes in the form of tax revenue. And so as a result, what happens? Because out there, the Federal Reserve can buy bonds. When they buy bonds, they inject money into the economy. They can also sell bonds. And when they sell bonds, they take money out of the economy. And that has control of the money supply. And I don't know if I'm going to have time. I've wrote some graphs on one of the boards over here, but I don't know that I'm going to have time to get to it today. In fact, I probably will not. Maybe I'll defer that to Tuesday, because it's what you want to see. But let me just see how this goes. What I do want to do excuse me, is talk about these tools here and the relative effectiveness one versus the other. Okay, so let's do that, and then we'll talk a bit about the other tool, which is not listed here or in your textbook, but is important to talk about, because for those who are following what the Federal Reserve has been saying to us for quite a long time, it is very important. So let's just do a bit of a chart here and talk about these monetary policy tools. Okay, let's talk about these tools of monetary policy, and let's sort of give a bit of an assessment to their relative effectiveness. Okay, so we say that we have three tools. Okay, we have the so-called RRR, that's the required reserve ratio. We have the discount rate, and you can sort of running dry here, and then we have open market operations, which is the active intervention in the bond market. Itself to only government bonds. They've been doing things like buying things like mortgage debt, student loan debt, car loan debt. What people don't realize is a lot of times these loans that are originated by banks are bundled up and they're sold to others as investments in the market. And this has been the case with mortgage loans for a very long time, but also things like student loans and car loans and all kinds of things. And so if we talk about a policy direction, we're talking about this idea of monetary tightening versus monetary loosening. And when we talk about the supply, what is the effect on the supply of money? What is the effect on GDP? Okay. All right, and then we want to talk about, and also bring this over here to the other board. I will swap the camera here when it gets time to get to this part here. So I've got limited board space, and so I got to kind of use what I've got, and maybe I can actually see here. Yeah, there we go. I think I can get it all on one shot there. Okay, let's talk about these individually and talk about what's going on And remember, we're talking about monetary policy. These are the tools. And the goal is to either increase the money supply or decrease it in order to do what? To influence the supply of money, but also the availability of credit. Not the willingness to lend or to borrow, but the ability to lend and to borrow. Keep in mind, when rates go up, people may have, even borrowers may have a willingness to borrow, but they may not qualify. And I think we're starting to see this happening in the mortgage business. Rates are so much higher than what they were on mortgages that some people who probably would have been able to buy a home of worth, whatever, name a dollar figure, now cannot do so because the payment is so high relative to their income, they don't qualify. And that's part of the availability of credit, that sort of rationing of credit that happens. So what if, in fact, this rate, by the way, this is a percentage, right? As is this one, these are both percentages. And so what if this direction is upward, and that the Federal Reserve decides to raise the required reserve ratio? Then what does that do throughout the economy? Well, what it has the effect of doing is it reduces the money supply. That is, what happens is if a bank has to set aside more in the form of reserves on deposit at its own Federal Reserve district, means there's less money available to lend and invest throughout the economy. So if the interest rate then is the price of money, and money itself has become more scarce, then what do we think the price of money is going to do? Well, it's the price of anything that becomes more scarce, it goes up. If the price of money goes up, borrowing slows down, particularly the impact on that most important part of the demand side, that's investment. And when I say most important, I mean the most volatile. Investment spending tends to slow down dramatically. What we're seeing with construction, which is part of that, so GDP will tend to go down. Remember, let's just do a quick aside here, that if the little I, the interest rate goes up, the big I, cap, goes down. Remember, the I here is the same I in the expenditures approach to GDP. C plus I plus G plus net exports. C is consumer spending, I is business spending. Business spending is very much influenced by the interest rate. These are big ticket items, typically like construction, 18-wheelers, cranes, forklifts, all those kind of things. If the rate goes up, it makes it more expensive to do, so they do less of it. If the rate goes down, this goes up. And so this, where have you seen this? It's like the law of demand, right? Well, this is the law of investment demand. The law of demand says that if one thing goes up, i.e. the price, then the quantity of that other thing goes down. And that's what is happening here. So if the little I is going up, the interest rate, then investment spending goes down. And that contributes to increase in GDP, which is the goal. Now, why would the Fed do that? They would try to do it in order to slow the economy down, to get rid of some of the excess inflation that's going on. It's just what the Fed's doing right now. Whether they're working with the reserve ratio is a different story, but that's what the goal is. What on the other condition, what if the Fed lowers this percentage and then it frees up money? So if this was a case in which players are being taken off the field and put on the bench, now they're coming off the bench and being put on the field. So now you've got more players, if you like, to keep the sports metaphor alive. The money supply goes up. If money becomes less scarce, then the price of money goes down. And if that goes down, investment spending goes up, which brings up overall spending. And it's not just investment. In fact, your text, rightly so, talked about the fact that consumption is also very much tied to this, particularly on durable goods spending. But I mostly want to focus on investment because it's much more, as a category of expenditure in the C plus I plus G model, it's much more responsive to interest rates for all the elements of it, whether it's new construction, whether it's inventories even. Firms finance inventories a lot of times with borrowing, or whether it's plant and equipment, almost everything in that category. Whereas in consumption, the C, not everything is interest sensitive, like services and whatnot. If you're going to get a haircut, you're not going to worry about the interest rate. Or if you need to go buy a detergent or whatever, you're not going to, it's not an interest rate decision at all. You're not probably going to borrow money even to do it, right? So this is what does this in the opposite direction. It forces investment spending up. And yes, consumer durable spending is impacted by it. But it's an important thing, but I really wanted to focus mostly on that, okay? What about the discount rate? That's the window in which banks and other institutions can borrow from it. If the Federal Reserve is raising the discount rate, then what it's doing is it's shrinking the money supply because of the fact that money becomes more costly. And so as a result, if the discount rate is going up, then it could be the fact that banks don't want to borrow. It raises the cost of borrowing even to banks, which again have their own banking needs. And so as a result, that goes down. If that goes down, investment spending, or the little I goes up because money becomes more scarce. And this is an interest rate anyway, so this is by definition what's it drives down. It drives down GDP as a result. Okay, and just the opposite is the case if the discount rate goes down. The discount rate goes down, it's a lower rate of interest, it makes money less scarce. Price of money is going down, so the supply of money goes up. If the supply of money goes up, the interest rate goes down because it's less scarce, and that brings GDP up. Okay? Very same effect across the board in terms of these arrows. And so this is the important thing for us to realize is the fact that the top line of both of these are what we call monetary tightening or contractionary policy. The second is what we call monetary loosening or expansionary policy. And I'll talk a bit more about that, particularly on Tuesday when we come back. I don't think I'm going to have time to sort of recreate this one graph leads to another, which leads to another, which I'll do. I just don't think I'm going to have time to do it once we get through this. Okay, I'd rather not race in order to do it. Okay, well, what about open market operations? Okay, this is now a little bit different here because what we're talking about is we're not talking about a down kind of thing. We're simply talking, are we buying or are we selling? In this case, we're talking about the Federal Reserve being what's called a net seller of bonds. And again, the top row in all these three categories is monetary tightening or monetary contraction. A net seller of bonds. Now, what do we mean by net seller? It means that the Fed, it may be buying and selling, but on balance, it's more selling. The Federal Reserve has got a gigantic amount of bonds already on its books, on its own balance sheet. And because they've been buying bonds over many, many years, and so they've got plenty of capacity to simply dump bonds onto the market. So if they do that, what happens? Well, somebody who's holding a bond on Tuesday now is holding, or somebody who's holding cash on Tuesday has now, is now out there buying a bond from the Federal Reserve. So the money supply goes down as a result. The money supply goes down because people who, were holding cash now are holding bonds. I'm not talking about the Federal Reserve, I'm talking about just people throughout the economy, banks, insurance companies, individuals, whatever the case might be. And so as a result, the money supply goes down. If money becomes more scarce, the interest rate goes up. If the interest rate goes up, investment spending tends to fall. And so that brings down GDP in general. That's to the net selling of bonds. Sorry, somebody keeps texting me. This always happens in this class for whatever reason. So, all right. So I apologize. I'm always an offender of this. So, okay. So a net seller. So in other words, they can do buying and selling both, but they're on balance. They're more selling. They're putting bonds on the market. By the way, this is also not inconsistent with what we talked about before. If you wonder why on Tuesday we went through this whole dance about the bond market and what happens to bond prices. Well, think about this: if the Fed is dumping bonds on the market, when something becomes less scarce, whenever anybody's selling, the price of that something goes down. If the price goes down, the interest rate goes up. So that's essentially the same mechanism. The reason we got one of the main tools that traditionally, especially in the last several decades, the Federal Reserve has used to control monetary conditions is by this intervention in the bond market. What's interesting is back in the late 90s, in which when the government, overall, the Treasury was actually paying off a lot of federal debt because we were actually getting budget surpluses, which is very unusual in the last several decades. Federal Reserve Chairman at the time said, what do we do if we don't have any more bonds out there? Because that's the way that we intervene in the market. Obviously, it didn't work out that way. The government went back into deficit, and so we have had no shortage of government debt. In fact, government debt is about $30 trillion, and so we're not any scarce on federal debt at all. So that's one policy direction. It sort of mirrors these top tier of tightening, that is contractionary policy. What if the Fed, on the other hand, is a net buyer? They're doing some buying, doing some selling, but on average, it's buying. Then everything reverses itself here. And it's not just Treasury debt, it's also student loan debt, it's all the other things. Well, somebody who's holding a bond on Tuesday now is holding cash. So that increases the money supply. If money becomes less scarce, the interest rate goes down. If the interest rate goes down, GDP spending tends to go up because money is less expensive. Okay, so those are the three tools. Now the question is, okay, are they all created equally? Are these relatively effective? And And how do we rank these in terms of their effectiveness? Because it's one thing to draw these nice little arrows. It's another thing for us to assess the relative effectiveness of these. And so let's talk about the relative effectiveness. Let's take the required reserve ratio first, and let's ask ourselves, how effective is it? And when we talk about this, we're saying it's not very effective. Here is why. There are a couple of reasons why this is not very effective. First of all, it's mostly it's a little bit outdated in some ways. When the reserve ratio was first set up, I mentioned this in class on Tuesday, it was set up primarily as a way to prevent against bank runs, which despite the fact that we had an actual bank run 3 weeks ago, they're not very common. They really are not. In the 1860s, though, during the Civil War, there was a great need to have financial stability because the war itself had to be financed. And so the National Bank Act was passed as a way to sort of strengthen the banking system. And one way to do that was to create these reserves as sort of a buffer, because of the realization that banks are, in fact, houses of cards. And if everyone wants their money out in the form of withdrawals, it's not there. And so this was basically a cushion. But increasingly in the last few decades, because bank runs are so rare, and I know that in saying this, it sounds like I'm missing the whole bank run of 3 weeks ago, but not really, because that's the only one. The only one before that that I can think of is 2008, a very small bank run on Washington Mutual. And before that, the only ones that I can think of in my lifetime, and I think I'm probably the oldest person here, was in the 1980s when not banks, but savings and loans had a run on them, but they were very poorly regulated. And they were truly houses of cards on steroids, some of them. Some of the people, depositors, actually did lose money because they weren't insured. And that today, I don't think anybody would sit still for having depository institutions that were not federally insured. So this is what it was initially used for, was to prevent against bank runs, but increasingly it's used to sort of control the money supply as a tool of monetary policy. But it's not very effective. And one reason why it's not very effective is one that is maybe a little bit more informal, but is a reality. And that's the fact that it drives banks crazy when the reserve ratio changes, because it makes all the window they've got to make changes and whatnot. So it's not changed very often. And in fact, on the M2 part of the non-M1 portion of M2, I don't believe right at the moment there is even a reserve ratio. So it's not very effective. In other words, zero reserve ratio. So it's not very effective. What about the discount rate and the discount window? How effective is that? Well, no, this is not very effective. Or well, are we? So this is also not very effective. And the reason this is not very effective is because, so why is this not very effective? Well, one reason why is because historically, the discount rate and the discount window mechanism has been something that is almost like serving as the lender of last resort to a bank that was on its last legs. And that it's the last lender to go to is the government itself. And so it's usually a signal that there are real problems with that bank when they borrow from the discount window. They don't want to do it. It's very public information, and there's a stigma behind it. And back in 2007, when the subprime mortgage crisis was just beginning to rear its ugly head, the Federal Reserve itself was trying to change that perception by saying, look, not only should you not have a feeling of stigma, but instead we encourage you to borrow. In fact, we will extend the terms to you, the repayment. We'll include non-banks, even other financial companies like investment firms, insurance companies that can borrow from us. And so as a result, but it didn't really work. It's almost like borrowing money from your parents. Big brother's looking at you, and hey, when am I going to get repaid? I mean, it's really that sort of thing. Very tight credit terms, even if they've extended it. I want to say it's still pretty tightly. They're sort of watching you, standing over you. And I don't think people like the big brother aspect of it. Because banks still, even after the Federal Reserve has tried to change the perception, it really hasn't worked very well. So we're 2 strikes. We've only got 1 strike left. And that final strike here is open market operations. And fortunately, this is very effective. And the reason it's very effective is because it is very quickly, in fact. And wants to make a change in the money supply, can either buy or sell bonds. And what they do is they simply instruct the Federal Reserve Bank of New York, which is the agent of the particular policy, to go in and start buying, or selling. And they can inject money or take money out of the economy very, very quickly. So it's very effective. And it works very well. And so as a result of these three tools, this is the one by far. These aren't really even used that much, actually. So these formal tools are sort of disappearing. And having said all this, then I come back to where we sort of began, and that's talking about a rate that goes right along with the discount rate, and that's called the Fed funds rate. And that's a pretty good stopping point for today. So when we come back on Tuesday, I'll talk a bit more about the Fed funds rate. And then I'll get into this. I've got a series of graphs that will show how these steps of monetary policy work throughout the economy. That is, the Federal Reserve is raising or lowering rates. What does that do to the money supply? What does that do to the credit conditions? And then what does that do to overall economic output? And so that's what we're going to get to on Tuesday. So are there questions for me about anything that we talked about today so far? Okay. All right. Well, have a great weekend, everybody. And I will see you on Tuesday.